So welcome back to the Wyckoff Starter Sequence series, and this will deal with the process of accumulation in the market. And the two best examples that we will show today will be the bond market on the daily, weekly, and on the S&P daily chart as well, since those have been two of the markets that have been the biggest bull market, and we can see that the aspect of the markets is shown the best in that regard. And we had gone over the distribution process, and obviously the accumulation process becomes the opposite process in that market, in the procedure of Wyckoff. And one of the things that we see here in the accumulation process is that we'll go through some ending action that will lead to some upside movement, and that will lead to markup in the situation. So we'll pay very, very close attention to some of the bar behavior and the action that occurs in the market. There are several ways actually that a market can bottom during the accumulation phase. Is one through the selling climax, and one could be so much of a shorting of thrust, but in both cases they will need demand to come into the market. So you will go through that process, and sometimes this process is not only one bar, it can be two bars as far as that's concerned. So let's go through the process of the accumulation process that's easily shown as far as that goes. So let's do our disclaimer. There's a substantial risk of loss in trading commodities, futures, and options. Past performance on indicative of future results, and the opinions here expressed through carried forth LTG LLC are not to be taken as recommendation to buy or sell commodity future options. This is for educational purposes based upon the teachings of Richard D. Wyckoff. So let's go through the process of the accumulation, starting from the beginning and going up to the markup phase in the particular market. Let me spread this a little bit more quiet, a little more wider. As a matter of fact, we can get a little better perspective of the bars. So as we can see, this market has been going to a corrective phase. Let's just take this as a downtrend for practical purposes in the market. And we know that in order for that market to have a situation where the market needs to be at a point to where it needs to turn around, we need to see the market have some type of ending behavior and some type of process of accumulation to go higher. Okay, so what we see is the first market begins to get breaks down to lower levels, and the volume increases. We can see something very, very important down here, and subsequent lectures we'll go over up thrusts and springs and various different things in subsequent lectures in the intermediate series that I'll be doing. But more importantly, we will see something that we have a market that goes lower, very high volume. The market then goes lower on volume that's just as high in the market, but with a very much smaller range. Much smaller range. I can make this a little bit larger so you can see it. So the range is smaller than this, and the volume is about the same. This is what we consider effort versus result in the market. Okay, so it's a very critical aspect of the behavior, and we'll get those in the intermediate section down the road. Suffice to say, we're doing the accumulation process at this point. So this is some type of red flag, possible stopping behavior, and then we get a rally up to the market. Okay, the market runs out of steam with the volume, and the market does correct to go lower. We know that we don't buy any first rally in market weakness. We need to see some type of secondary test. Then we get to a situation where we get a wide bar here with very high volume, indicating that the supply is still present in the market. The next bar that we see is a small range bar that is almost a spring of the previous day bar. Spring is the penetration of the low that goes above it. We see a penetration of this. Even though the volume is around 60% of the day before volume, the range is only about maybe 30% of the day range. So we consider this an effort versus result red flag again, because we get to a point to where the market gets to the level we can get to the point where the market gets to the level where we can compare the volume during the price in the area that the market is trading in. So here we see the first possible red flag when the market makes the low. Then we see the subsequent red flag when the market does make a new low and on the retest or some type of behavior. This says nothing about demand coming into the market whatsoever. It tells you that the market does get buying at lower levels or the red flag is there, but it says nothing about demand. Just because the market's being bought, it doesn't mean that it's demand. It can be stopping action, not be demand. So a demand bar would be a wider range bar with increasing volume. A market that could be a buying bar could be a situation where the market does this, where the volume is very, very high, there's a shorting of the downward thrust. Obviously, there's buying by the CM who's buying what's being sold to them. So that is buying the selling, where this is easy moves up. This is just demand that goes higher. So we see the market goes higher from this area, and what's very key about this particular red flag or stopping action is that we now see that the market has follow-through to the upside. The market has follow-through to the upside, which is something that is very, 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 very critical. So this is the demand, this is the supply bar, the vertical supply bar that shows that selling is so prevalent. If we draw a line going across that vertical supply bar, because high volume, large range bars tend to get retested, if we show that to be the case, then we will see at this point where we need to see demand overcoming supply in the market. This being the supply coming into the market, this supply coming into the market, we now have to see demand overcoming supply in order to have the situation of the market to go higher. We see this market going through this price, going higher, and staying above this price level. This resistance now becomes support to the market. So let me draw this line a little bit straighter for us. And we now see the market forms resistance, then becomes support in the market. What we can see is that during the accumulation phase of the market, again, when the market has a hard bar down from here, this market was lower but had no follow-through. Had no follow-through to the market, okay? So what we see here is a market that gets to the level in which the market breaks but has no follow-through, so the bears do not take advantage of that situation. Okay? So when this market held the support, which again was created by the supply bar, this is an area now that the CM should most likely defend the market's behavior. Okay? So what happens here? That the market goes higher, goes above this supply area bar, and it comes back down here. Now the CM defends the area of support established when the supply bar was here and demand overtook supply here. So now we have this ICE support right here in the markets. And we know that during the accumulation process, that the market that gets bought at the ICE support of the market, is where the accumulation process takes place, at the bottom of the trading range of the market. So the market is now being defended by strong hands in the market, and we see that because the market does not go under that particular market. So what we see is the market tries to slam down an increasing volume, but then the volume tends to dry up when the market gets to the point to where the market gets to the support. So, in order for the supply to really be important, we need to see the market get to the point to where the supply has followed through to the downside and that the support area does not hold up and the market goes through support. As long as this market will hold this support area, then that is where the CM could find the market behavior where he would buy the market because he finds that the market has value. So once this market was overvalued, created a supply bar, once demand was created to provide this market to go higher, this area where the demand overcame supply came in, comes to an area where the market is in imbalance or the market has value at that level for the composite operator to try to buy the market. As we can see, the market then gets bought off of this particular low, but the buying is not that great off the low at this point, but we do see the market have not had the follow through. We do have markup, but we have a decent retest, okay, of that support. This retest of support, the market needs to run away from. So it's okay that the market makes a low and eventually has a retest to the behavior, okay? Market has eventual retest of the low, but eventually we have to run away from this danger area, otherwise the market will fall through to the downside, indicating that supply that was in the background will take over and will take control. So unless the composite operator defends, unless the market defends that aspect of the market, unless the market defends that aspect of the market, we will see if the CM has the gumption to provide support to the market that goes down to those levels. So we could see that when the market tried to come with supply, the supply eventually dried up, and the CM was willing to buy that market. It did a fairly poor job initially, but then this is why the market had a retest back to support. The market had a retest back to support, and what's very important is that we see that the volume came in on the retest of support. This indicates that the market had some buying in the market. This indicates the market has some buying in the market that told you that on that retest, after the supply came in, or the selling came in, the market was able to show buying to come back in the market. What's critical about this buying in the market, in order to be part of this accumulation process, that the market ultimately needs to find the demand to come into the market. The market still needs the process of going from bearishness to bullishness and needs to see the market at a point to where the market needs to see demand. The next bar here, we see increasing volume, increasing bar length, and the market is in a bullish tinge. And then now the market should perform well, considering that now we've gone up. We would take one bar to retrace 1, 2, 3, 4, 5, 6 bars of being sloppy to the downside. We take one bar that goes up and shows strength in the market. So when we read the tape, in tape reading, if we have a situation where the market goes one bar up and has a situation where the market just grinds lower, if one bar establishes the demand, and let's say 8 bars establish the market going back, it tells you that buying is prevalent to selling, which leads to higher prices. So that is reading the test because the market is staying near the higher price. The market is accepting higher prices. When a market accepts higher prices, the markets have to go higher to see where the market finds its true resistance in the market. So if a market accepts prices in a store, if the market gets sold at one type of price and the homeowner wants to sell the market to get to the point where it goes higher to increase his prices, if too many people are buying it at one particular price, he may raise his prices to try to get more value out of it until people eventually say, that's too high, I'm not going to buy it. If you remember with the gas, when gas was going up here, people, for the most part, were willing to pay higher prices for gas. It never got to the point where people really, it got to some degree where some people stopped buying gas at $4 a gallon, but for the most part, since we love our driving in this country, people still were able to pay for it. It happens, another classic example, happens in situation when we have people that buy cigarettes. There will always be probably some price that people always put a value on owning cigarettes, but as it gets too high, people just won't do it. But we all in our lives have a situation where our favorite product, we probably would pay more for our favorite product to buy because we like it so much, but things that aren't as acceptable, things that we don't like as much, we're willing to give those up if the price gets too high from the standpoint of market behavior. So we see the action and we see the situation in which if the market accepts higher prices, the market will have to go higher to get to the point where it cuts off that demand. That's what they do with interest rates as well in the markets today, is that they will keep raising interest rates in order to cut off growth. Or they will keep, in this case that's happening today, they will cut interest rates or keep them low if the economy is weak because they want to stimulate the growth in the market. They want to stimulate growth in the market. Okay? So the point of the matter is, that they'll keep rates low to try to stimulate it, and they'll cut it off by raising the rates. So in this case, the market is accepting the prices here. It ran away from price, and again, we can see this one bar here in the tape reading. One bar here. It took 1, 2, 3, 4, 5, 6, 7, 8, 9 bars. It took 9 bars to retrace this one bar of strength. So once we have this market that gets above this area, we can now draw our line from our vertical demand bar and our highest volume bar. We can now draw the line of our support from this demand bar right here. Okay? From this demand bar right here, that will establish the ice. And I told in previous lectures that now we see the lines change when we see markets changing overall. So we now see the market, we draw it from our demand bar. We then draw it from where we get this selling from. This establishes some type of trading range that occurs in the market. We'll draw this line straight. And we now see the market get to the point where the market forms this little trading range that we see the market forming the sideways behavior. So what happened was we established some type of range in here from this high. We draw from the selling bar to the buying bar, and we draw a trading range. Don't want to confuse you here. We draw a trading range from this reactionary high to this reactionary low that leads to higher prices. And now we've established a higher trading range that occurs in the market. We'll take this line off from this other side. Market then will draw a line across from here, from this demand bar. and now we form a higher trading range. Okay, so the trading range is here, and I said this line is wrong. This line from here to here, we draw another trading range that occurs. Okay, and the market then goes through the process of this demand bar here. We have 1 bar, 2 bars that establish to the upside here. Okay? But before we get to that, the market then has a situation from this demand bar. We see that the market tries to retest it, and it has buying that goes on. Market tries to retest it, and buying that occurs. So every time the market gets on a retest of this vertical demand bar area, right, we now see that the market then gets to the point, and now we get to the level to where the up bars are generally stronger than the down bars in this situation. Okay? And when the market has to perform, the market does perform. Also, if you notice, from the lows, we see the market making continuing higher lows and continuing higher highs. Most people don't see that as this process is unfolding, but it's very, very important because the market is showing evidences of strength by the ability of the market to make higher highs and higher lows, a series of them. Well, you know that we call a series of higher highs and higher lows, we call that an uptrend. And we want to go with trend as often as humanly possible when we trade any of the time frames that we trade. So in this case, the up bars being greater than the down bars has allowed the market to be in a situation where we see the market is at a level to where the market's may be able to make upside progress in the particular market. So very subtly, you see that the market is making higher highs and higher lows, and most people do not see that. They only see very, very myopically what happens, but they don't see the whole picture. That this market action situation where the market is making higher highs and higher lows as far as that goes. So what happens is that the market then gets to the level. Then when the market gets to that level, we make a higher high, higher low. It establishes the uptrend, which then would require a sign of weakness to turn down. Okay? So the market then gets to the level in where it leaves the particular higher established trade range, leads the trading market, but then we have an interesting phenomenon that happens right here. We talk when we look at markets that retrace back, if this was the low of the trading range and this was the high of the reactionary high, if we talk about halfway back in the market, it's right around this area. Just eyeballing it. Okay? Just eyeballing this is about the 50% retracement level. The 50% retracement level of the trading range here. That is where we expect the market to hold if the market was continuing the bullishness. This holding after the market goes above the creek area and then goes down to this level right here is what we call the last point of support, or LPS to be short. Okay, it's the last in which the market establishes above this creek area resistance and slowly grinds back into it and goes probably about halfway back, and the market continues to go higher. Okay? And so what happens in that particular case is that we see that the market gets to the point where the volume begins to dry up to the up, dries up, indicating the lack of supply coming through after buying, the lack of supply coming through after buying, indicating that there's no willing sellers at resistance, which allows the market then to get to the point to where that retest of that demand area, the retest of the resistance, when it goes back down halfway back, the CM is willing to defend the LPS level, and the LPS is a move underneath the creek area. It's the last time that the market's checking any supply that's in the market before markup. So any supply or any market, it gets caught up in that little trading range, and then when that LPSY level is done, then the market establishes the continuation of the uptrend, and then the accumulation process continues all the way up. So the CM defends the area of support here, ICE support, after selling. It defends the ICE area of support here, as far as that's concerned. Okay, so there's two areas of trend. The market, then he defends the LPS level here. These are all part of the accumulation process. Accumulation process of buying the ICE support, the accumulation process of buying the LPS. Okay? If the market would stay, in our previous examples, if the market would have stayed at the level near the highs here, up here, it would have been absorption. But the fact that the market went back down to an ICE support or an area of 50% retracement back to support, this is part of the accumulation process that occurs. Absorption tends to take place near the creek area, and accumulation takes place near the bottom of the support area as far as that's concerned. And the market obviously worked itself higher through the accumulation process, and higher we went in the market. But you can see when the market went from selling, establishing this type of behavior. So if we want to label this as far as this is concerned, we can say that this is preliminary support. We'll say this is preliminary support in here. This becomes the selling climax, which gets stopped by a shorting of the downward thrust eventually, not the wide swinging. This would be considered the automatic rally. We refer to the whether on sequential order of Wyckoff. This would be considered the secondary test that occurs in the market. This establishes the secondary test. This will give us the high volume relative to the area. This will give us a sign of strength market. You're yelling at me as far as the number of lines I drew. Okay, this becomes a secondary test of the market. This establishes the trading range that we see. This would be considered some type of demand that goes into the market. This demand market that goes into the market. Market then stays in a larger trading range. The testing process, this becomes now our trading range that occurs, a larger trading range that occurs there. here, as a matter of fact, right? Includes that large trading range that occurs, that back and filling type of thing, because the market that's selling here, okay, it went down as the market establishes this left-hand side of the markets, this left-hand side of the market, talk about, right? The left-hand side of the trading range. As we go to the right-hand side, of the market, we eventually need to see that sign of strength that occurs leaving the trading range or within that trading range with high volume. Well, we see our area here with the large volume, the market has volume that increases here, so we have a situation where the market leaves the trading range on the right-hand side, which establishes a sign of strength. You could also question that at this point, I think it's kind of early in the process, called this a sign of strength, okay? But we definitely see the market getting to the point where the market leaves it from a sign of strength here into the market, as far as that, and then this establishes the market holding the particular gains, holding that trading range, okay? And the market comes halfway back and establishes and then goes higher. So you see the accumulation process, higher highs and higher lows. We see the supports being bought, the up bars greater than the down bars. All those factors included meaning that the market is undergoing the accumulation phase of the market, and higher the market went. The secondary test, this becomes, just to make this a little more complete, this becomes the trading range, becomes some type of sign of strength. Something. Some type of sign of strength. And the accumulation process then basically is complete, because we have the evidence of the left-hand side, we have evidences of the preliminary support, we have evidences of everything else. We have now the selling climax that occurs, wide range selling climax, preliminary support, the rally, selling climax, automatic rally, secondary test, trading range, markup. That is your accumulation process that occurs into the market. There's a classical accumulation process in the market, and higher the market was established and went higher. But you can see clearly the bottom information, the testing process, the rally, the secondary test, the strength, the up bars being greater than the down bars, volume increasing on the upside versus the downside, as well as the bar action. And we can see that the market's making higher highs and higher lows. And this is classical accumulation for the market to go higher. So we can see that very much in the market behavior of that aspect of the trading. We see the last point of support, market gets above the creek area, comes back down, and forms the market, establishes something that becomes very, very bullish to the market. So it's a very nice looking chart. Any questions, obviously please feel free to contact me, but this is a very nice schematic chart stopping action, testing, automatic rally, secondary test, trading range, markup, and boom. And the market obviously continue to mark up. So it's a very, very, very great schematic of the process of accumulation. Up bars greater than down bars. Down bars had no follow through to the downside. Any selling that was high volume to the downside did not follow through. Immediately went to buying. The market never had follow through, and it never had a markdown phase. So that is the S&P daily accumulation chart. Now we go to one that's more of a classical chart. Well, now we go to another chart that's very classical in the bond markets, in the weekly bond markets. It really doesn't get any much better. I know that's probably improper English, but it really doesn't get any better than this particular bar. So, and usually the bonds, at this point, the bonds have gone up with the stock market, lower interest rates that's been occurring in the markets. And lower interest rates has been in the markets. It's keeping stocks fairly well bid in the action. So as soon as this weekly chart comes up, we'll be able to show a very similar process to what the stock market did. And this is very much established market-wise. Almost a very similar chart to S&P, but nevertheless, it's an important lesson to follow. So, we see the market has some type of markdown phase, with the market establishing this large range of volume to the downside. Again, it's the weekly bond market. We see the market establishing the market to the downside, to the point of going lower. And then when we see something very interesting, we see kind of the slowing down of the down, but it's still somewhat bearish in nature. So then all of a sudden we see the market, instead of having a markdown bar from this weakness, we now see the market establishing some type of small range to the upside. Well, that obviously is not really bullish, but it is a kind of a weird place for that to take place. So instead of the markdown that occurs, in the market, we are now seeing what? We are now seeing the market kind of all of a sudden gets interrupted. And the market doesn't do that, and the volume begins to increase. So this is an effort versus result type of thing, and the market held up. So it forms like a little spring, but it's really an effort versus result bar, because we would expect markdown, and the market had a very small range and actually finished higher, indicating that there's some buying that occurred in the market. So we look at the effort versus result section of what we do, effort versus result section to what we do, we will see that this market has easy movement down, but the next bar that we see is increasing volume in a smaller range. This is some type of stopping behavior. As the market gets sold on this low, there is buying that occurs in the market. A, buying in the market occurs because the market goes high end. B, the funds expect sold new lows and immediately was gobbled up. So that market now gets to the point where the market has effort result, and then we have to see the subsequent action after it. Well, then we see the market tries to go down again, and the market has decent volume. Selling is still part of the equation, but fine, and the market tends to get a rally. This rally, because it has no cause, and because there's no demand in the rally, then stops at the area of previous resistance. So that's a very logical place for the market to stop at. Market that's bearish, it does not have cause. The market will go down there. The market will go down there, go up to the resistance area, and then come back. Very logical place for sellers to be, because that's resistance of the chart. And in a downtrend, you want to sell resistance of the chart. Okay? The market then establishes that high. Then the market continues to go lower in the simple retest. So we know that this is the first kind of rally that we had, but doesn't take a lot because we don't have demand. But we not expect the market to have demand on the left-hand side, so we don't really expect that to be the case. But we want to see the market at least show some signs of life or signs of some buying, so we'll see what the market takes us. The market then has a point. I know it's over the Christmas holidays. We now then have a point to where the market gets to the point to where the market goes down, market makes the lows, and the volume is the lowest volume probably of the year, or at least in a very long period of time. So that tells you that there's no buyers in the market. That tells you that the market is no volume, large range to the downside. The buyers are just backing away from the market. The market is just backing away from the market. Okay? The next bar, look at the volume. The volume actually increased relative to the wide bar. The market's on here. So any selling that went on after this bar here was bought. Now, it doesn't seem spectacular, but the fact that the market had a much, much smaller range and more volume is really impressive, because even though everything is relative, right? The small range, small volume, it's a very small range, but the volume increased from the day before where the range was wider. So that always draws a red flag. Again, only bullish if the market then establishes a market that shows upside bullishness to the market. So if this meant anything down here, we need to see follow through to the market. We need to see follow through to the market. So what do we get? We get the market that establishes a wide range up bar, and look at the volume come in. High volume relative to where we've been. It's a couple of days after the New Year's. High volume, large range to the market. Okay? High range to the market. Goes higher. Okay? So, very, very critical aspect of the market, because now the market reacts to these particular, we understand what this represents now, because the market now took that out. The market rallied. So we understand that what we thought about the possible red flag type of thing, that up bar does tell us that we're probably right, that it's kind of a red flag. Okay? So we see that behavior happening. Now, after the market has shown some demand, we see something very, 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 very important. We see that the market held now above this selling bar, and the market now has been in a situation. The market now has been in a situation in which the market's able to maintain the gain of the market. So this bar here, that was stopping action bar, we want to draw that line across, because it's where the market tried to spring and then marked back down again. The market went down again. So we want to draw that line there across, and now we get to the point where the market now has demand overcoming any supply, because this is supply that moved the market lower. So the criteria now of the market jumping higher above that resistance area, the market jumping higher above that resistance area now gets to the point where that resistance here now becomes support. This is support, and it's where the I support comes in. It's where now the CM will find value. This will assign value to the market because the resistance now becomes support. The resistance will now become support, and now any area to that area will be bought. Well, we see the kind of bounce off here, see the market here, and now we see on the right-hand side of this little trading range, we now see a high-end close in a market that goes higher. So what we've seen in the market was some type of possible red flag here. We have had some type of market that went up and retested, went exactly resisted, retested, then tried to go down and tried to have another red flag that occurred in the market, forms another trading range. This trading range now leads to a jump over this little creek area. Okay? A little bit of a jump over the creek area. So, what's very critical aspect of the market, is that this high-end close on the right-hand side of this market indicates maybe possible leaving the range. This is the wide bar that occurs in the market on the right-hand side of the market's behavior. Okay? Of the market's behavior. So it really doesn't classify as a sign of strength bar because the volume is not really there, but the action is there. But it does indicate some type of strength that occurs in the market. So this strength bar gets retested again here to the support area of the market. The support market. So it forms this particular trading range that occurs. So if we really don't get to the point to where the market shows that really sign of strength, even though it acts as a sign of strength, okay, because of how the market behavior is, we can classify this as this preliminary support, the selling climax, okay, the automatic rally that occurs, and now this trading range that most likely is accumulation because of the behavior that occurs subsequently, the demand rally, the demand back here, subsequent to that behavior of the sideways action that occurs in the market. We've established that the reactionary high that was in a retest because of the supply here, reactionary high, now if we form it longer, this takes out long-term resistance. This is a very important high to take out. It's where Wyckoff describes the reactionary high before the low. Very critical in the aspect of Wyckoff. Earlier we talked about the reactionary low before the high. This is reactionary high before the low. This is where above this level is where markup occurs. We get to this point where markup begins to occur. The market retested area, and boom. So what is very important is that the reactionary high before the low becomes the area when it gets taken out is when the markup phase to Wyckoff begins, and the accumulation phase has basically gotten to the point to where the market now has established the upside of the market, and when the market reacts from the reaction high before the low on the retest is where Wyckoff believes the market marks up from, and you see that after the market got to that level, the market moves up. So that's a very, very, very important aspect of the market as part of the accumulation phase of the market, because we see that the establishment of resistance taken out this bar, retested, secondary test, building cause, the accumulation phases happen at the edges here. That's where the accumulation phases happen at those particular areas. At those particular areas in which the market being supported at ice support. So previous creek now becomes ice. Again, the reactionary high before the low, resistance now becomes support in the market. Report in the market. And the market then gets to the point where we see the behavior in acting, instead of getting supply at resistance, the market's not getting demand at resistance. And that is when the change of behavior occurs, because that is when demand is overtaking supply. So here's supply coming in. This is where, at this point, where demand overtakes supply. This becomes the retest in the accumulation phase. The accumulation phase occurs. This is the retest of accumulation. Occurs. It happens on the retest of the support. The CM again defends that support, defends the market because he finds value to the market. And we see, again, reactionary high, repeat again, this is so critical, before the low, it's taken out. This is absorption, taken out, because the market stays near the highs, taken out, held in here. It's a very critical area, so it takes a long time for the market to go through. In fact, it has to retest it again, because it's such an important area, the reaction high before the low, that the market just hangs around there for a while. But once it does it, and the retest holds, then you know that the accumulation phase is in earnest, because we know that once the market does not mark, let's say mark down from here, no, that's a red flag, but once the market begins to mark up from here, retest and goes higher, that's exactly what I say the accumulation phase is, when the supports get held, it holds up, and the market then does what? Like the other chart, this market now is establishing higher highs and higher lows. Higher highs and higher lows. As long as the market establishes these higher highs and higher lows that occur in the market, this market will go higher in the market. This market will go higher in the market. And that's exactly what you see as far as that's concerned. Okay? So, bottom line is, supports hold, lack of follow-through to the downside, demand overtaking supply, the market getting above their reaction high before the low, and now the market establishes an uptrend, and here we go. And this is classical Wyckoff chart of the market going higher. And the market went higher. This is a current chart of the bond market as well, as I like to show current charts. So we see the situation of, we can label this as the market moves up. Preliminary support, selling climax. The selling climax actually is the market that actually, selling climax, I think it stopped. The dramatic rally that occurs also as part of the trading range. Trading range. Jump over the creep. We set an up thrust because one of the three bars usually happens. It's not an up thrust that occurs in the market. Market then goes back to the point, retest the support level. Retest the support level. And shows once it retested, you immediately get buying. Immediately get buying in the market. It's very important that once it gets retested, that buying does resurface by the CM. It does. The market makes new highs. So this is very good price action after the market gets to support. Very good price action after the market gets to support. The reaction is very, 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 very critical to what happens. So a good reaction here, same thing here. Market establishes higher, market going higher. The market then gets to the point where it retests back down to support. And the market shows up very, very well, because then when the market has to retest, it shows up with demand that occurs in the market. Okay? But retest here, reaction up. This is all part of the accumulation process, support holding in the market, establishing higher highs, higher lows, holding the support. The up bars are greater than the down bars. You do a correction, you have no follow through to the market, to the downside. You have no follow through to the market downside, no supply coming in. Market immediately works back higher. Any stopping action in bearish market gets immediately bought by the market to go higher. That is the most critical aspect of it. Again, establishing higher highs, higher lows, support being held, and running away from the danger area is very, very important. Another classic example of the accumulation process of the market going higher. This is spelled wrong. Obviously, it should be accumulation. Okay? When you review these tapes in the webinars, you'll see that the market, you'll see these charts very clearly from the aspect of it may not make sense the first time you go through it, but if you go through it and you see this action, you'll see how the labeling is very well done. And one of the things is that not all charts are always classical. You have to read into a lot of different things that occur into the markets. Okay? And we see that established very, very well in this particular case. So there's the weekly bond. This is the weekly bond accumulation phase of market. And we will do the last bond market chart, will be the daily chart. We will get to a point where we will show this in a little bit smaller time frame than the last one, but nevertheless showing that process that occurs. This is where we get our charts. So basically, very, very important to see some type of bottoming action and see the market reacting the way it reacts. Very, very important. Okay. To me to make everyone go a little bit nuts here as far as that goes. So I want to take this particular action, and I want to take this, just since we did the weekly charts, everything, I want to take this market a little bit differently from the aspect of that, and show you something that is part of this action accumulation process me show you something important. So in this particular case, we do have a market that actually takes out the resistance area-wise to go higher. But I want you to focus on the accumulation, that basically the reaccumulation of a market that I think is pretty important. Okay, so we have established that the market has shown some strength to the market to the upside. Obviously, we've shown some strength to the market to the upside. Okay, and we went through the weekly chart as that as well. So we said we know that vertical demand bars and vertical supply bars are areas in which we want to see the market hold and hold quite well to the market. So we have established that the market has had some vertical demand bars, one right here, one right here. We always mark these. And we have another one that occurs right here. Okay, so that is very, very, very important. So the stronger the market becomes, the less of the pullback the market has. Makes a lot of sense. If a market doesn't have a full retest of a trading range, but only goes halfway in that trading range, the market is stronger for not going to the bottom of the range and holding up to the 1/3 to the 1/2 part of the range, right? It's a stronger market behavior that occurs as far as that's concerned. Okay? So the market establishes a particular low, and what happens? Lo and behold, it's a retest of a vertical demand bar. So this is demand bar, right? I have a spelling right. This is demand bar. This retest of a demand bar that gives us an edge to buy the market. It gives us an edge to buy the market. Then the market goes higher. We have some shorting of the thrust, not part of our discussion today. The market pulls back down, and lo and behold, the market then has a retest of the ICE support, right? Retest of ICE. Market there, market reacts, and we formed our full-fledged trading range in the market. We formed our trading range in the market. Okay? We formed a trading range in the market, but we are coming from strength in the background. We are coming from strength in the background. Okay? Since we're coming from strength in the background, this higher trading range is most likely accumulation. It is accumulation without the supply present. So if there's no supply present, if there's no supply present in the market, if there's no supply present in the market, okay, if there's no supply present in the market, this sideways trading range, will be absorption. The sideways trading range will be absorption to the market. Okay? So no supply coming in. I mean, even though the market breaks, it's not supply. Okay? Even though the market breaks, it is not supply that comes into the market. Even though the break is happening, no supply coming into the market, and the market holds that support several times. In this particular case, the trading range that leads to it, no supply in the market, retest of a demand bar, so supply would have to overcome demand. The market then gets to the points on the right-hand side of the market, and the best rally that we see in this sequence of the trading range is right here. Okay? It's right there. It's a spring of the retest of the ICE before markup. And in one of the previous webinars, I've noticed I mentioned this before, but here it comes again. This is the last spring before markup begins. It's called what we refer to as a terminal spring. Terminal meaning, what terminal means. It's the last spring before markup is called the terminal spring. So we have to wait for the market to mark up to actually label it, right, as a terminal spring, don't we? So the market then forms this terminal spring in the market, and the market begins the markup phase. So this accumulation phase is clearly seen by the market. Is also, by the way, a lesson for the trading ranges. We sometimes I bled the kind of lectures together in showing you this portion because many times the story takes in many different aspects of the chapter. So we see the establishment of the trading range clearly intact, right? Clearly intact. The area that it has marked down here, giving us creek, the mark going through some areas here, even though this is an area that we can mark too, but we're marking the high, marking the area here of resistance of creek, marking this area very easily. The ice is very established by the demand bar, retested the demand bar, retested of the demand bar, retested the market. You see how the market keeps bouncing off these levels. This gives us the best type of action that occurs here, the widest range. The market then occurs back. Now the market establishes the trading range. And now we also have the market having a low to a high. Take another concept there. About halfway back, the market held the 50% pullback of the range. So instead of pulling back all the way, indicating some type of, not weakness, but the market not ready to mark up yet, now, instead of the market coming back all the way down to this again, the market now has established the market at the 50% level, indicating that the market may be ready to go in the go position, because now instead of retracing all the way down to support and not being ready, the fact that the market now gets to the point of support, halfway back, and then the market holds up halfway back, actually forms somewhat of a little spring halfway back, somewhat of a spring. So this is the demand bar in the middle. This could even be halfway back, right? Maybe in here, type of thing. Okay. We now see the market holding above this halfway back to the market, holding up well. So instead of this market retracing all the way back down to here, the market holds in the upper third of the range, at least to the half of the range. Okay? And now then the market has markup again to the market, but this is absorption holding the halfway back, accumulation here, a buying of the break, and the market overall absorption of this resistance area has to absorb something, absorption of this resistance area, and then the market rallies up nicely to the upside. So it's a very classical thing of trading range, accumulation at the support area, you can see the bouncing off, absorption at the creek area, and some type of sign of strength on the right-hand side of the market leading the trading range. In fact, this is what it actually is. Sign of strength, the largest volume, the largest range to the upside. This is a jump over the creek. This is a retest of the jump over the creek. Okay? And then the market retests and goes higher. The market retests and goes higher into the market, and we establish the fact that the market now has shown uptrend, higher highs and higher lows in the market, and everything, the ingredients that we have for an accumulation process is present, support's being held, no fall to downside, the reaction from the support levels, the fact that the market stayed near the creek area for absorption, the high volume, jump over the creek, sign of strength market, and the market goes higher. So we established two different markets, the bond market and the stock market of absorption, accumulation rather, to go higher. And this particular bond daily chart shows all the aspects of a lot of the lectures that we did today with the trading range, absorption, accumulation, markup, and everything else that we discussed in some of these previous webinars in the starter series. So that's all for the section on accumulation, and I hope this was very helpful. These bars, you study these bars, they'll be very helpful in identifying the areas of accumulation. Thank you very much, and see you down the road. Thank you. Bye-bye.